Okay, so let's take a look at what's going on. In fact, I'm going to put myself in the little window down here. So, hope you guys can see this. Okay. All right, let's go through indexes. All right, this is SPX or SPY. SPY has been grinding higher since April, right? We had the bottom in April. We'll just keep grinding. We had like some little 4 or 5% sell-offs in between. This is the April low, okay? This is 1 year, 1 day. I like my charts clean, so not too many lines drawn. A lot of people are saying this is going to roll over. Well, one thing that I've been saying for the last few months now is that indexes are not going to go anywhere, especially SPY or SPX, S&P 500, because it's a market cap weighted index and Mag 10 rules. Mag 10 is a massive, massive part of S&P 500. I'm not sure what the latest percentages with the sell-offs that we had, especially in Microsoft and some other Mag 7 names, but still, I'm pretty sure it's over 60% of the S&P 500. So indexes are not going to go anywhere this year unless the Mag 7 goes somewhere. Now, if you look at an equal weighted S&P 500 chart, it looks completely different than this, okay? And but small caps, mid caps have been outperforming over the last 2 months after underperforming for close to 4 years, 5 years, which is, let's say, an index like Russell 2000. So this is the S&P 500. Well, to me, I mean, is it a rollover? I don't know. But we could just keep bouncing off of a same low, and we just kind of bounce off of 7,000 on SPX or 700 on SPY, and we're just kind of stuck in this range. When this range is taken out, this is technical jargon, folks. When this range is taken out, you should expect a big move, right? When I say big move, to the tune of probably 10%. And this is triple Q, which is the Nasdaq 100. It looks kind of the same, although it's a little further from an all-time high. But basically, we've been just grinding sideways on triple Q, and we've been just grinding slowly higher on SPY. Should that be considered a loss of momentum? Yes and no. But again, SPY is not going to go anywhere unless the Mag 7 or Mag 10 moves higher, appreciably higher. Well, where are those at? Well, those are at, let's start with the Mag 7. Here's Apple, retested the high, now it's selling off. But again, Apple has been the same price as it was last September. Here's Amazon. Amazon actually is looking kind of negative under its 200 EMA, but if you look at Amazon is actually selling at the exact same price as it was selling last May. So that's why SPY is not going to go anywhere, due to the fact that these mega trillion companies are massive parts of the index because they're market cap weighted, right? Here is NVIDIA. Look at NVIDIA. NVIDIA has the exact same price as it was last July, right? I mean, I don't know if Tesla is still considered in there, but Tesla is the same price as it was last September. And here's Microsoft. Microsoft actually has been selling off quite hard, 550 down to 400. And Microsoft is basically approaching the April lows during the Liberation tariff musical chairs crisis. And Microsoft is selling where it was selling literally like in May of last year, right? And then, Meta is selling at the exact same price as it was selling again last May. So to me, if these stocks don't move appreciably higher, index as an SPY or SPX is not going to go anywhere. And same thing with the triple Qs. Triple Q actually is underperforming a little bit because, again, vast majority of the 100 stocks is these Mag 7, Mag 10 stocks. And then I don't know if still Netflix is in there, but look at Netflix. Netflix is actually selling where it was selling 2 years ago. So my point in all this is this is not a stock market. It's a market of stocks. A lot of you, I'm pretty sure, invest in, indexes, dollar cost average, things like that, which is great, fine. But if you're stuck in a Netflix from 134 to 75, if you're stuck in a, Tesla, or if you're stuck in, because Tesla's selling where it was selling 3 years ago, 4 years ago, it's the same price. So you're just basically round tripping, right? So indexes are not going to go anywhere unless these Mag 7, Mag 10 stocks make a major move. And if if you are caught in in a Netflix, let's say, which is cut in half almost, without the market selling off, my question to all of you is, where is Apple, Amazon, Meta, Microsoft? Google actually is the best looking one out of the Mag 7, although kind of rolled over now, but you guys can see the difference, right? Google actually has been the best performing Mag 7 stock or Mag 10 stock, going back since the lows in April. And full transparency, I'm long Google in my long-term port at 152. But again and again, so it's a market of stocks. It's not a stock market. I think going forward, next couple of years, indexes are not going to go too much. And I think it's going to be a stock picker's market. Because there's many, many, many wonderful companies who are outperforming all the Mag 7 for a while now. And, you just need to find it. You just need to find those needles in a haystack, and they do exist. And so for me, indexes are going to underperform going forward, the major indexes, S&P 500 and triple Qs. And even if they may even sell off, actually, to be perfectly honest, the way it looks, is the question is, what will happen to a Microsoft if the indexes start selling off, if S&P 500 starts selling off? Is it going to rally? Is it going to do a counter trend move? What's going to happen to Amazon, right? Again, these companies are not going anywhere. These are major, massive companies that are worth investing over probably long periods of time, but this underperformance has to be noted. And you have to understand something when you're investing. There's opportunity cost, right? A lot of people are just ride these things up and down, up and down. Yes, over long periods of time, stocks do go up. I agree. But maybe there's also has been time in history that stocks went sideways for 10 years, 12 years. There are at least 2-3 occasions that I remember, and then go check your history. It is a fact. And if we're in those periods, then you have to be more actively investing and doing a little bit more research and finding some of these gems that exist. And when you say gems, right, you have to follow rotation. I mean, a lot of people are just blinded by, okay, Mag 7, Mag 7. Well, now Mag 7 outperformed for 3-4 years. Now maybe it's not time to do that. And then while you're waiting for these Mag 7s to do their thing again, you're missing a lot. You're missing, it's called opportunity cost. And I don't think anybody talks about it or pays attention to opportunity cost. I mean, for example, if you're Walmart is not a small company. I mean, look at Walmart. Look at the difference between Microsoft and look at Walmart, right? Yes, they're different businesses, but why not be in Walmart in this phase as opposed to be in Microsoft, right? I mean, yes, Microsoft may do well going forward, but it's already a $3 trillion company, market cap company. How much growth is left in there, or an Apple or Nvidia, let's say, right? So if you look at Walmart, you wouldn't know that the market's grinding sideways. Well, why not be in a Walmart as opposed to waiting for the Mag 7 to outperform again, tech to come back again? So my question in all of this is, for the indexes, my conclusion is, for the next couple of years, I think we're just going to kind of go sideways. We may get a sell-off if the economy slows down, but I don't know. But the sideways grinding higher in a tight range, kind of up 5%, down 5%, is pretty normal. But then what I read on X is a lot of people are just complaining about, my account's down 50%. Yeah, because you're holding, let's say, a stock like Oracle, right? Oracle is not a small company. Not long ago, about 3 months ago, 4 months ago, Oracle was 345 a share. Today we're at 160. That's more than half, cut in half. This is not a small company, folks. So my thing is, again, over long periods of time, stocks do go up. But then what individual stock you're in is going to decide how your portfolio does going forward, as opposed to if you just invested in an index over the last 5 years, you did amazing, right? Well, is it normal that an index, if you dollar cost average into an index and it went up on average 20% last 5 years in a row, is that normal? No, absolutely not, because the current history suggests that it's about 10, 11%, including invested dividends. Well, look what's happening now, right? So what if the indexes are sideways for the next 2, 3, 4 years? You can still dollar cost average, you can still be invest your dividends, but expect over long periods of time, and I'm talking longer, much longer periods of time than 3 to 5 years, indexes return 10%, 11% on average, and that's the S&P 500, and that's the benchmark everybody competes with. Very few can beat it. And that's, if you're not an active investor, that's the best thing to do, especially if time is on your side. So that's what I see on the indexes.